Every day, billions of dollars change hands as investors buy and sell shares of companies big and small. And as an investor, your goal is simple: to buy low and sell high. Sounds easy, right? Well, not quite. Stock picking is a skill that requires knowledge, patience, and discipline. It's about uncovering hidden gems in a sea of options and making informed decisions that can lead to financial success. And that's exactly what we'll explore in today's video. So, whether you're aiming to build a diversified portfolio, seeking growth stocks, or looking for value investments, this video is your comprehensive guide to mastering the art of picking stocks. By the end of this journey, you'll have the tools and insights you need to navigate the stock market with confidence. But remember, investing is a journey, not a destination. There are no guarantees in the stock market, but with the right knowledge and strategies, you can increase your odds of success. Without further ado, let's get started. The first step is understanding the business itself. Think about this way. If you don't understand how a company makes money, what drives its growth, and what risks it faces, you're essentially gambling with your investment. Let's take a practical example. If you own an Apple device or use their products, you probably have a good understanding of their business. You know they make iPhones, iPads, and Macs. You might even know about their services like Apple Music and the App Store. Now, imagine you're considering investing in Apple stock. Because you're a customer, you can assess the quality of their products, stay updated on their latest innovations, and understand their brand loyalty. This brings us to the next point. Start with what you know. By investing in companies whose products or services you use and love, you have a head start in understanding their business dynamics. When you invest in a company you know well, it becomes easier to follow their performance, stay informed about industry trends, and make informed decisions. Now let's talk about the advantages of investing in what you know. Confidence. When you understand the business, you have more confidence in your investment decisions. Risk mitigation. You can better assess the risk associated with the business. Long-term vision. It's easier to take a long-term view when you believe in the company's future. And resilience. You're more likely to weather market volatility and hold on to your investments during tough times. Assess the company's financial health. Next, it's crucial to evaluate a company's financial health. Think of it as buying a piece of that business. Look at the company's balance sheet, income statement, and cash flow statement. Here's a breakdown of what to consider. Let's dive in first to the balance sheet. This financial statement provides a snapshot of a company's financial position at a given point in time. Here's what you should consider when evaluating it. 1. Cash position. Check how much cash the company has on hand. A healthy cash reserve can indicate financial stability and the ability to weather unexpected challenges. 2. Debt levels. Examine both current and long-term debt. High levels of debt can be a red flag, as it may indicate financial strain or limited flexibility. 3. Current ratio. Calculate the current ratio by dividing current assets by current liabilities. A ratio above 1 suggests the company has enough short-term assets to cover its short-term debts. Now, let's move on to the income statement. This statement provides a summary of a company's revenues, expenses, and profits over a specific period. 1. Total revenue and net income. Review the total revenue and net income figures. You want to see consistent growth in revenue and positive net income over time. 2. Net profit margin. Calculate the net profit margin by dividing net income by total revenue. A higher margin indicates a company's efficiency in turning revenue into profit. Lastly, the cash flow statement. Think of the cash flow statement as the financial GPS of a company. It shows you how money is moving in and out of the business, providing valuable insights into a company's liquidity, solvency, and overall financial health. Let's start by dissecting the 3 main sections of the cash flow statement and what each one reveals about the company. 1. Operating activities. This section deals with the company's core operations. It includes cash generated or used in day-to-day business activities such as sales, expenses, and taxes. 2. Investing activities. This part focuses on cash flows related to investments in assets like property, equipment, or securities. It shows whether the company is investing in growth or selling off assets. 3. Financing activities. This section accounts for cash flows associated with the company's capital structure, such as borrowing, repaying debt, and issuing or repurchasing stock. It tells you how the company is financing its operations and growth. Each of these sections provide a unique perspective on the company's financial story. Now, let's break down some key metrics and insights you can gain from the cash flow statement. 1. Operating cash flow. This figure shows the cash generated or used by the company's core operations. Positive operating cash flow is a sign that the company can sustain itself without relying on external financing. 2. Free cash flow. Free cash flow is operating cash flow minus capital expenditures. It indicates the cash available for debt reduction, dividends, share buybacks, or further investments. 3. Cash flow trends. By examining trends in the cash flow statement over time, you can identify patterns and assess the company's ability to manage its cash flows effectively. Check key financial metrics. In addition to the financial statements, consider other important metrics like the price to earnings or P/E ratio. The P/E ratio compares the stock's price to its earnings per share. It helps gauge the stock's valuation. Remember to compare the P/E ratio within the same industry for meaningful insights. Let's break down the P/E ratio into its fundamental components and understand how it works. The P/E ratio is calculated by dividing the stock's current market price by its earnings per share or EPS. The formula looks like this. P/E ratio formula on the whiteboard. P/E ratio equals market price per share divided by earnings per share or EPS. This ratio tells you how much investors are willing to pay for each dollar of earnings generated by the company. Now, let's interpret the P/E ratio. High P/E ratio. A high P/E ratio typically suggests that investors have high expectations for future earnings growth. It may also indicate that the stock is overvalued, so be cautious. Low P/E ratio. A low P/E ratio may indicate that the stock is undervalued or that investors have lower growth expectations. However, it could also mean there are fundamental issues with the company. Comparative analysis. To gain more insights, compare a company's P/E ratio with those of its peers in the same industry. A higher P/E than competitors may indicate a premium stock, while a lower P/E might suggest a bargain. Keep in mind that the P/E ratio is just one piece of the puzzle. It should be considered alongside other factors, like the company's growth prospects, industry trends, and macroeconomic conditions. If the P/E ratio is not available, you can use the price to sales or P/S ratio as an alternative. To understand the P/S ratio, let's start with its basic formula. The P/S ratio is calculated by dividing the stock's current market price by its annual revenue per share. The formula looks like this. P/S ratio formula on the whiteboard. P/S ratio equals market price per share divided by revenue per share. This ratio helps you evaluate how the market values a company's sales. Now, let's interpret the P/S ratio. High P/S ratio. A high P/S ratio may suggest that investors are willing to pay a premium for the company's sales, indicating high growth expectations. However, it could also mean the stock is overvalued, so be cautious. Low P/S ratio. A low P/S ratio could mean that the stock is undervalued or that investors have lower growth expectations. It might also indicate potential concerns about the company's future prospects. 3. Comparative analysis. As with the P/E ratio, it's often helpful to compare a company's P/S ratio with those of its industry peers. A higher P/S ratio compared to competitors may suggest a premium valuation. Remember that the P/S ratio, like any single metric, should be considered in the context of the company's overall financial health, industry dynamics, and macroeconomic factors. For instance, consider two companies in the technology sector. One is a well-established giant with stable sales, and the other is a high-growth startup. The former might have a lower P/S ratio due to its mature nature, while the latter could command a higher P/S ratio based on its growth potential. Examine the management team. A company's management team and leadership are crucial. Research the company's executives, board of directors, and CEO. Look for stability and experience, as long-term leadership can be a good sign. Determine competitive advantage. Competitive advantage sets a company apart from its rivals. It can be based on factors like brand strength, patents, innovation, or unique business models. Companies with a strong competitive advantage often have a higher chance of success in their industry. Diversify your portfolio. To reduce risk, diversify your investments across multiple stocks. Don't put all your eggs in one basket. Consider investing in a market index fund for broad diversification. And there you have it, the 6-step checklist for investing in stocks as a beginner. Remember, investing is a long-term game. Make informed decisions based on the company's financial health, leadership, and competitive advantage. If you have any questions or need further clarification, please drop them in the comments below. Thank you for tuning in. Check out more videos about how does the stock market work and mastering the basics of investing in stocks. These videos will offer you priceless knowledge and information to assist you in reaching your financial objectives. Until next time, see you in the next video.